Hey, what's up? It's France here. Welcome back to the channel. So in this video, we're going to answer the questions in most people's minds, which is it better to pay off your student loans first completely and then investing afterwards? Or is it better investing right off the bat, paying the minimum payments on your student loans? So we're going to run through the numbers in this video, and then I'm going to show you guys exactly the results of that. And then definitely watch towards the end of the video, guys, because I'm going to show you how investing in different asset classes such as crypto can produce even better results. All right, before we get started, I would definitely appreciate it if you guys give me a thumbs up below. It really helps with the YouTube algorithm. I'm really trying to grow my channel. Subscribe to my channel if you haven't already, and also hit the notification bell so you get notified when I post my next video. Start off with the basics and talk about inflation rate first. So as you guys can see, the month of July, we actually hit well over 5% inflation rate. And as you guys can see here from the historical chart of United States inflation rate, we haven't really hit 5% since the 2008 financial crisis. And some argue that we might actually sustain a 5% inflation rate level. So why do I bring that up in this video? So I want to bring that up because of this fundamental reason right here is, can inflation help borrowers? Okay, like if wage increase with inflation, and if the borrower already owed money before inflation occurred, then inflation benefits the borrower. Okay, so basically in layman's terms, the higher the inflation rate is, the more it'll help borrowers such as student loan borrowers. Okay, so essentially, if your thesis is we're going to go through an inflationary environment in the United States and the world, then it will benefit you to have inflation in the market because it'll benefit borrowers like you and me. The only reason I am so convicted in terms of making this video is the fact that I myself have student loans. Many of you that follow me know that I have a pretty large crypto portfolio, not yet in the millions, hopefully in the next year or so. But the reason why I built my crypto portfolio is because I paid off my student loans at the bare minimum and chose to invest in crypto instead. And guys, one more thing, for those of you that are Americans, just know that student loan payments is frozen until January 2022. And if that was me, I give not financial advice. The fact that we're not paying off student loans until January 2022, including interest free, I'm definitely not going to pay off my student loans. I'd rather invest that in crypto if that was me. Again, not financial advice. All right, let's go ahead and move on towards my calculation, whether it's better investing right off the bat or paying off your student loans completely and then investing afterwards. So I'm going to do a little case study back in 2009, comparing the S&P 500 and the NASDAQ later on. Okay, so let's start off with a key few assumptions. So let's start off with the assumption that your disposable income every year, the amount of money you're willing to invest or the amount of money you're willing to aggressively pay off your student loans, is going to be $1,000 a month. So on a yearly basis, that is going to be $12,000 per year. Okay, so assuming that $12,000 per year, student loan interest rates, I went ahead and looked it up. What is the average student loan interest rate? So the average student loan interest rate is roughly 5.8%. Okay, so we're actually going to plug that in, 0.058%, and change that as a percentage. Okay, so assuming an interest rate of 5.8% and you were to aggressively pay off your student loans using our key assumption of $12,000 per year of disposable income, you would be finished paying off your student loans roughly somewhere in the beginning of 2013. So as you guys can see here, we finally turned negative, meaning you paid off your student loans. Okay, so somewhere in 2013, meaning in 2013 all the way until now, you would be investing. Okay, again, this is only a case study. This is what were to happen in history if it were to occur. Okay, so let's actually take a look at the S&P 500 in TradingView and see what were the returns from 2013 all the way until now, 2021. So let's actually go to TradingView and go to the S&P 500. And again, we're starting with the year 2013. Somewhere in the early part of 2013, we were to start investing. So that would be, let's just say March of 2013 all the way until now. So that would be 187% return. So let's calculate the compounded annual growth rate, how much interest we're making per year compounded annually. So 189% return, that's turning $1 into 2.89. And 2013, 14, 15, 16, 17, 18, 19, 20, 21. So that's roughly 8 years. So roughly 8 years of investing. That is a compounded annual growth rate of roughly 14.19%. Okay, so let's go ahead and plug that in our assumptions. Interest rate is 14.98%. Let me just make sure. Yeah, 14.19 actually. So 14.19, and go ahead and convert that to interest. Okay, so as we can see here, at 2021, our balance sheet is $165,000. Okay, again, we paid off our student loan, so we have no liability. So a lot of people are happy about that. You know, it took them roughly almost 20 years to generate a balance sheet of $165,000 on their account. Okay, now let's move on to the next assumption, which is paying the minimums on your student loans and then aggressively investing the remaining disposable income. So as you guys can see here, our minimum payment is going to be our disposable income times 0.25. So we're using 25% of our disposable income to pay off the student loans, and then the remaining 75% to invest. Okay, and again, let me just go ahead and change this to equal the student loan rate right here. With that, guys, as we can see here, in 2021, we barely made a dent on our student loans. We still have roughly $48,000 of student loans, because as you guys can see here, we're paying, majority of our payments is going towards interest. Again, we barely made a dent, but let's look at the magic towards the investing side. So assuming we invested right off the bat, guys, that would mean that we started investing in the year 2009. So let's actually go back to 2009 and calculate our CAGR, our compounded annual growth rate. Okay, so back in early 2009. So where was that? So sometime roughly right here, January 2009. Okay, all right. So assuming we invested right here all the way to now, that is roughly a 574% return. So that is a 6.74x. So plugging that in, that's turning 1 into 6.74x, okay? So in terms of the number of years, that is from 2009, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20. So it's roughly 12 years, just over 12 years, but I'm going to round it down to 12 years, okay? So 12 years of investing, that's 17.23%. Okay, so let's move on to our calculator and change that to 17.23%. And again, guys, for tax rates, again, we're going to use the after tax rate, because if we were to invest, we would pay a tax on that of roughly 30%. Again, this might be different depending on what country you live in, depending on what state you live in, but I'm going to assume a slightly above average tax rate of 30%, okay? So using in our example number 1, after tax rate of 9.93. And for this one, because we invested right off the bat, after tax rate of just over 12%, okay? So we're using 12% on that. Okay, so if we were to take a look at our balance sheet at the end of 2021, we have $257,000 in assets and liability of $48,135. So take our assets minus your liabilities. Again, guys, I was a former accountant, so I'm a nerd when it comes to these things. So here we are. Our equity, okay? I like to think of things in terms of equity, which is assets minus liabilities, again, from our former accountant. Okay, so our equity is going to be $209,000. So if we were to compare that to investing in our student loans first, aggressively paying that off, and then investing afterwards, our balance sheet was only $165,000 versus aggressively investing, our balance sheet was $209,000. So pretty much, if you compare person A here, the conservative person, versus person B, the aggressive person won by $44,000 by the end of 20 years. I mean, that's good money for me. I mean, at the end of 20 years, I'm $44,000 richer than person A. I'll take that. Now, let's actually one up that, guys, because we all know that the S&P 500 actually was average. I mean, there were other indexes like the NASDAQ, which contains Amazon, Facebook, Google, that perform much, much better compared to the S&P 500. So let's actually take a look at an even more aggressive investor. And again, definitely watch towards the end of the video. We're going to talk about crypto at the end, okay? Let's talk about this aggressive investor that paid off their minimum payments on their student loans, plus invested in the NASDAQ, which is a more aggressive investment compared to the S&P 500, okay? So first off, let's start off with the person that finished off paying out their student loans in 2013, started their investing career sometime in early 2013 and ended sometime around now, okay? So let's start that off mid 2013. So I would say roughly March of 2013. So March of 2013 would be somewhere here. going all the way up. That's 443%. So let's calculate the compounded annual growth rate, the CAGR. Okay, 443, that's going to be a 5.43. Okay, that's turning 1 into 5.43. 14, 15, 16, 17, 18, 19, 20, 21. So roughly 8 years, guys. So roughly 8 years. Calculate that. That's 23.55%. Okay. And again, just by the investor choosing the NASDAQ over the S&P 500, we already improved our compounded annual growth rate. So as you guys can see here, the balance sheet of an aggressive investor that invested in a better asset class, in my opinion, back in the day, was better off at 221,000. Okay, that's much better off than the previous investor who invested in the S&P 500. Now let's calculate the investor that paid off the minimums on their student loans plus invested in the NASDAQ right off the bat. Okay, so that would be starting in 2009, and calculate the CAGR of the NASDAQ. That's 1576. Okay, that's turning $1 into 16.7. That's roughly 12 years, guys. So roughly 12 years of investing. Let's calculate that. So a little bit higher CAGR, 26.44%. Okay, so let's go ahead and plug that in. Again, this person invested right off the bat in the NASDAQ. And as you guys can see here, you know, just by investing in the NASDAQ, a better asset class compared to the S&P 500, you're already $136,000 better off in the span of roughly 20 years. You're already $136,000 better off than the person who invested in a NASDAQ, number one. And also you're better off than the person who aggressively paid off their student loans. Okay, so if we were to rank the person in terms of net worth, okay, so person A. All right, guys, so I've quickly produced the rankings of the balance sheet of each person. So as we can see here, the person that benefits the least is the person that aggressively paid off the student loans. So whoever that is, his balance sheet is much, much less 20 years later. Next up is going to be person B, the person who paid off the minimum payments on their student loans plus invested in the S&P 500. Next up is going to be the person C, person who invested minimum payments on their student loans plus invested in the NASDAQ. All right, guys, now let's save the best for last and actually bring in person D, okay, which is going to be the minimum student loans plus invested in crypto. For this one, we actually do have to make assumptions because then again, these are future returns. These returns haven't really happened yet, okay? So with that, I want to show you guys the total market cap of crypto right now. So the total market cap of crypto right now is just under $2 trillion, guys. So as you guys can see here, it's 1.8 trillion. So not even $2 trillion, okay? So if we were to take a look at the last best asset class, right, which again consisted of Google, Amazon, Facebook, like really goats in the tech asset class, okay? So the NASDAQ has a market cap of 19.4 trillion. So I am really biased when it comes to crypto because then again, I hold 98% of my portfolio in crypto, so I'm really biased. But guys, if you believe that crypto will be the next NASDAQ, if you believe that crypto will change the world, okay, if you believe that crypto will be the next financial revolution, then it's really safe to think that crypto one day, not anytime soon, I'm not saying crypto is going to hit $20 trillion in 5 years. No way. I mean, one day, guys, crypto will eventually hit the 2021 numbers of NASDAQ. That might be in 2030. Some people are actually calling for crypto to hit a $10 trillion market cap in roughly 2 years. 10 trillion, okay? But my safe assumptions are we'll hit 20 trillion roughly by 2030. The NASDAQ might be a lot higher by then. The NASDAQ might be at 30 trillion, okay? But I think that crypto will be roughly at $20 trillion, okay, by the year 2030. So let's actually calculate that, the compounded annual growth rate. So right now, crypto is roughly $1.82 trillion. And if we were to hit my $20 trillion valuation, again, that's 2022, 3, 4, 5, 6, 7, 8, 9, roughly 9 years, guys. So roughly 9 years, we hit my $20 trillion valuation. Look at that, guys, 30.52% return, compounded annual growth rate. And again, guys, that is really conservative. If you follow my channel right here, you're actually going to improve your compounded annual growth rate because we're going to take profits, okay? I believe that crypto will have one more boom and bust cycle. All right, we'll probably hit the $10 trillion market cap, retrace back down to 5, and then go up to 20. So if you follow my channel right here, we're going to improve this compounded annual growth rate. So over here, 30.52, and same thing for here. Change this to 30.52. These years are going to be wrong because these are my case studies, but assume that this is going to be the year 2030, all right? So in the year 2030, the person that invested in crypto right now in 2021, in 2030, he or she would have a net worth of $276,000. Not that bad, okay? Not that bad. But then look at this, guys. The person who invested, again, imagine this is 2030, not 2021. The person who invested right off the bat has an asset of 499,000 with an equity of 451,000. Again, you're better off by $174,000 over the span of roughly 9 years, guys. So over the span of 9 years, you've outperformed that person who paid off their student loans aggressively. All right, let's say Ethereum becomes the next Amazon, and then you invested in Amazon roughly around 2014. Okay, so 2014 all the way until now. So that is going to be at 1,319% in a span of 15, 16, 17, 18, 19, 20, 21. So just under 7 years, you essentially 14 extra money. Just one stock alone, Amazon gave you a 45.79% compounded annual growth rate from the year 2014 all the way until now 2021. Okay, just one stock alone. It's too late to invest in Amazon. Do I believe that Amazon will produce a 45% annual growth rate between now and 2030? Heck no. I mean, I'll bet my money on that Amazon, I mean, if the US were to produce $10 trillion a year for the next 9 years, sure. You know, with money printing, with absurd money printing, yeah. You know, but if we were to just keep our money printing just like we've been doing it, there's no way. There's no way Amazon will produce a 45.79% annual growth rate. So with that said, if you pick your right asset class, especially crypto, plus within crypto, if you pick the right tokens, the right crypto to invest in, Ethereum, Cardano, Bitcoin, and you play the ratios, you could definitely perform just like Amazon at 45.79% growth rate. So finally, guys, that final piece of this video, let's just go ahead and plug that in. If we were to perform a 45.79% annual growth rate, you know, you're talking about $1 million portfolio. You pick the right asset class. You paid off the minimum on your student loans. You know, you waited about 9 years, 10 years. You're talking about $1 million portfolio. You know, again, I'm really close to this, guys. For those of you that follow my channel, you know, my portfolio right above $400,000. Again, I do have $50,000 in student loans, which I choose to pay off the minimums. Right now, I'm not paying anything off because of the Biden mandate of the frozen payments. So yeah, I created my portfolio because I paid the minimums of my student loans. So I'm not telling you this, you know, as financial advice. Definitely do your own research. This is not financial advice, but I myself have done this, guys. The reason why next year, hopefully, my portfolio can approach the $1 million mark is the fact that I paid off the minimums. And currently, right now, I'm not paying off anything, right? I myself have done this before. Again, guys, I hope you enjoyed the video. Again, if you haven't liked the video, definitely like the video down below. Subscribe to my channel if you haven't already. And also hit the notification bell so you get notified when I post my next video. I'll see you next time.